Hello class, and welcome to the sample problems for chapter 1. I am going to try to break these up into multiple videos to make it easier to locate particular problems when they are due. But these are the sample problems that we'll be going over from chapter 1. They are meant to accompany the MyLab videos and show you how to solve different types of problems within MyLab that should help you out with the homework for each chapter. We'll probably be covering chapter 1 in more than 1 week, maybe even as much as 2 weeks, because there's quite a lot of information in this chapter. You can see there's about 12 in-class exercises or sample problems here that we'll be working on. So if you have any problems or are getting stuck on any of these at any point in time, please feel free to reach out to me as your instructor. The first problem that we have here is using the expanded accounting equation. If you don't already know what the accounting equation is, please watch the posted MyLab video link that explains what the accounting equation is. But essentially, what we're looking at here, let me just grab my drawing tool, our accounting equation equals assets equals liabilities plus equity. That's the basic accounting equation, and then we can break those down into subcomponents for equity. And the subcomponents for equity include revenues, expenses, and owner withdrawals or dividends. All right. So those are our basic components that we're looking at here. So they were kind enough to give us the drop downs here to select from. So liabilities plus owner's capital. Sorry, owner's capital is the fourth component here. So that would be the money that owners invest. And it says, let's see here. Minus, so we're watching these plus and minus signs because some things increase your owner equity and some things decrease your owner equity. So owner's capital increases your owner equity. Owner withdrawals that you withdraw from the company or dividends reduce the equity in the company. Revenues or money that you bring in from your primary activities increase your owner's equity, and then expenses decrease your owner's equity. All right, so with that, then we can use this formula to solve for any one component here. So on the one side, we've got our assets, which equal 71,288. And so all of these items on the other side should add up to that. So if I take these and then I total up what is on the other side, they gave us liabilities of 2260. We're not sure about the equity that was put in, right? That's what we're going to solve for, the owner investment. We've got 14,420 for owner withdrawals, 53,085 for revenues, 28,675 for expenses. So I'm going to put in the positives and negatives here. The owner withdrawals would be negative. That's a decrease. Revenues are positive and expenses are negative, right? So if I sum all these together, it's going to select all those. I'm using an Excel formula here, equals sum, and then a left parentheses. And then the first cell that I'm adding up here is C9. And then the colon says, take everything in between these two cells. The last cell I'm looking at here is C13. So this will sum all of these up, and it's going to treat them as a positive number if I don't have a negative in front of it. If it has a negative, it will subtract it, right? So the total then, and I can also do this, by the way, by highlighting these, it will give me some summary statistics. So the sum of these numbers, positive 2260, negative 14,420, positive 5380, minus 28,675. gives us 1,250. So if I take the difference between our assets on the left and this total we have on the right, that gives me a difference of 59,038. So if I were to put that there, then my totals for assets and these numbers right here would all add up to the same amount. So my liabilities, 2260, the owner's capital I just solved for, 59,038. The owner's withdrawal of 14,420. Revenues of 53,085 and expenses of 28,675. And I don't have to put those in as negative because it's telling us what it's going to do with the number right there. All right, so that is our accounting equation. And you should have the same numbers that I have here for these ones because it says book static here. All right, so moving on to our next problem here. Okay, we see this same accounting equation that we just used in our previous problem, only now we are going to look at what is happening in our double entry accounting system when we have some different entries to make. So I'm going to take this, I'm going to widen this out so I can put my numbers right over here and have them next to these problems that we're solving. So the first transaction that we have here, right? We have a business that we're operating and we are, let's see here, looking at Lawler Lawn Services transactions. So we're going to look at these in the order of time chronologically, beginning on May 1st. So we received $1,700 and gave capital to Eric Lawler. So Eric is starting a business and he's putting $1,700 into the business, and what he's getting in exchange is ownership of $1,700 in his business. So we receive $1,700. So we are going to increase our cash column over here. And we are giving capital to Eric Lawler. So that's going to increase our owner's equity over here. All right. Now, our next transaction, we are purchasing a mower for our landscaping business on account $1,440. So what that means is if we see those magic words on account, that is cluing us in that we did not exchange cash. We didn't receive cash. We didn't pay cash. So if we're buying something and we're not paying cash for it, that means that we owe somebody money for that. And they're saying they're putting it on their accounts, which means they're expecting us to pay that in the short term, okay? But what we paid for this mower was $1,440. So we need to record that we have purchased equipment for $14,440 here. And then because this is a double entry accounting system, there's always two different accounts that will be hit. So we have our assets are increasing by 1,440 through the increase of this equipment account. And then we also owe an account payable here that we are expected to pay in the near term for the same amount. All right. Now, they're asking us to balance this out. So we're going to say, all right, what were our balances for each of these accounts now after these two transactions? So we had $1,700 in cash. We had no receivables, $1,440 in equipment, $1,440 in payables, $1,700 in owner's equity. We've had no withdrawals, no revenues or expenses so far. All right, so our third transaction we have here is we're performing lawn services for a client on account for $200. So when we perform services, we are going to earn what is called revenue, sometimes casually referred to as sales revenue. So we're going to record our $200 in revenue, which is going to increase the equity we have in our company. And it says on account. So again, on account means that there was no cash exchanged. So in this case, they owe us money. In the previous example, we bought a mower, we did not pay them, so we owe them money. In this case, we performed services for someone and they have not paid us yet, so they owe us money. So that is what is referred to as an account receivable. So we're going to record a receivable for $200. Whoops. Oh, I forgot. Let's see here. Oh, I forgot to put, oh, I put on the wrong line. Whoops. Sorry, wrong line. Needs to be on the transact. They want us to fill out the transaction line and the balance line, and I forgot that part. So we've got $200 there. Then we're also going to pull down these other balances that we had sitting out here. So I'm just carrying the previous balances down. All right, plus our $200 for assets and equity. There we go. All right, so these are where our balances are sitting. Now we've got our next transaction, which is paying $60 in cash for gas that is used in the mower. All right, so we're paying cash, so we're going to have minus $60 there, which 1,700 minus the 60 is going to give us 1,640. And then here we've got nothing. We don't need to put anything on there, but we're going to carry these balances down again. Oh, we got to get our other side too. So we paid cash for gas, by the way. So the gas expense is going to be over here. All right, now why does this one say negative and this one say positive? Well, we're decreasing our cash, which is a credit. So cash, a cash account is an asset account, which has a normal balance that sits on the debit side, right? So when we look at a T account, which hopefully you've watched some of the MyLab videos, when we have a T account for cash, on all T accounts, debits are recorded on the left and credits are recorded on the right. And asset accounts have a default balance, which is typically a debit. We label it DR for unknown reasons, but just because it's easy. Now, what that means is that to increase an asset account, we would debit it. So to increase cash, we would make an entry on this side of a T account on the debit side. And to decrease a cash account, we would make an entry on the credit side of the account, okay? Now, and every journal entry or every numerical entry we make in our accounting system, the debits have to equal the credits, okay? So just like in our accounting equation, the assets have to equal the liabilities plus equity. When we make journal entries, our debits have to equal our credits. So the normal balance of an asset account is a debit, and the normal balance of a liability account is a credit. Also, the normal balance of an equity account is a credit, okay? So because in every accounting entry, the debits have to equal the credits, so credit is what increases an equity account, right? So let's say that we've got, I'm just going to put generally equity here, all right? And debits are always on the left in a T account and credits are always on the right. Now with an equity account, credits will increase an equity account because it has a default balance of a credit. And debits will decrease an equity account. So assets are increased by debiting, equity is increased by crediting. So if revenues or sales increase our equity or our ownership value in a company, we would need to credit a revenue account, and expenses decrease the amount of ownership equity we have because we're spending things. So those would be a credit balance. So for this journal entry right here to purchase gas, we are crediting or decreasing our cash, and we are debiting our expenses, which is decreasing our equity, okay? So that's how that entry goes. But because these typically decrease our equity by default, expenses typically have a debit balance. Okay, expense accounts have a debit balance. And because revenue accounts increase our equity, they typically have a credit balance. So if we have a T account just for our gas expense, to record our gas expense, we would debit that for 60, and then we would credit cash for 60. And then our debits and our credits for that particular entry would balance out with each other. Okay, so I wanted to walk through that just so you'd understand what we were doing there. Okay, so going over here, I'm going to carry these balances down for the accounts that we didn't do anything with. And then this one, now we have 60. Okay. All right, so our last journal entry that we have here is that the owner is going to withdraw some of his cash that he made during the time period. So that's going to be a decrease of cash or a credit to cash of 300. So showing what that would look like in a T account. We would be crediting the cash for 300. And then we are going to be taking a withdrawal. I'm just going to put WD. So owner withdrawal, OWD. We would then debit that for 300 because debiting decreases equity like we just discussed a moment ago. All right, so that's going to be 300 there. So then we're going to have left over here 1,340 in cash, and then carry those balances down. And that gets us our ending balances for our accounts. All right, so that is problem number 2. All right. Let's move on to problem number 3 here. All right, so using the following information, calculate the return on assets. Now, the return on assets formula is net income divided by your average total assets. All right. So what do we use? What is return on assets? Return on assets is how effective we are at making income using the total assets that we have. And so it's what is referred to as a financial statement ratio. So we're going to take our net income divided by our average total assets, which I'm going to put TA for that, average total assets. Now, they gave us the net income, which is easy enough, just plug that in, but then we have to calculate our average total assets. So in order to do that, they gave us our beginning assets and our ending assets. So our average total assets is going to equal our beginning total assets plus our ending total assets. And we're going to take that amount and divide it by 2, okay? So if we're doing a formula here, I'm going to put parentheses around here to show that those are all part of the numerator, and then we would divide that by 2. So beginning total assets plus ending total assets, do that addition first, then divide it by 2. So we've got 76, let me do my parentheses, 76,000 plus 80,250. I'm going to take that and I'm going to divide it by 2. So by putting that in parentheses, then Excel will know to add those first and then take that total and divide it by 2. So That gives us average total assets of 78,125. And then when we do that math, we're going to take 5,000 divided by, the slash symbol is divided by 78,125, gives us return of assets, a decimal point, 0.064. They're asking for this in a percentage. So expressed as a percentage would be 6.4%, right? So converting from a decimal to a percentage, we basically multiply it times 100. So 6.4%. All right, and that is problem number 3. I will do one more on here, okay? So this is informational. We talk in chapter 1 about 2 different branches of accounting called financial accounting and managerial accounting. With financial accounting being primarily used for external reporting to regulatory agencies, to potential investors, and to potential lenders or creditors who we want to borrow money from. And then managerial accounting is primarily used by people inside of a business for planning, future planning, and decision making. All right. So investors, we can go down this list and say, are these people inside the business or are they outside the business? An investor is someone outside the business who is considering investing funds into the business to become a partial owner and hopefully make returns on their investment or earn money by having increased value appreciation of the company. So they are primarily interested in financial accounting because they are outside the company. A banker's interest in a company is primarily going to be to lend money, such as to purchase a building or other equipment. So they would be external again, and therefore that would be financial accounting. So take a second and think about these different organizations and or individuals, and are they inside the business or are they outside the business? And if they're outside the business, they're going to be looking at financial accounting. So pause the video here and think about that. And then once you've put a little bit of thought into this and attempted to answer this, then continue watching the video. And I promise it's worth your time to pause this for like 10 seconds, just fire off some answers, take a shot at it, and then do it because it will help you remember this much more effectively. All right, so hopefully now you're unpausing and we're looking at this. The Internal Revenue Service is an external organization, so they are primarily interested in financial accounting. Managers are working inside the business, so they are interested in, shockingly, managerial accounting. Controllers are they're at the management level of financial control within the company. They oversee the financial reporting of the company, work for the company, therefore they're primarily interested in managerial accounting. Stockholders are the same things as investors. They're people who have already invested, therefore they are outside and they prefer financial accounting. Human resources directors are inside the company. They are concerned with managerial accounting to determine whether you can afford to pay higher salaries or hire more people. And then creditors are people who are lending you money. They would be interested in financial accounting. All right, I'm going to do this last one here, and then I will switch to the other video. So we would like to start a cellular telephone equipment service business. We're thinking about organizing the business as a sole proprietorship. Identify the advantages and disadvantages of owning a sole proprietorship. Now, the best part about a sole proprietorship is that it is super easy to organize. There's not a lot of paperwork involved. You can just say, hey, today I own a business, and voila, you are a sole proprietor. So easy to organize is definitely the biggest advantage of owning a sole proprietorship. Another advantage of a sole proprietorship is that you both own it and manage it, so there's no disagreement between the owners and the managers. So unification of ownership and management is an advantage. The third advantage here is that because there's no legal separation between the owner and management, there's less regulation associated with it. So they try to streamline things to make it easy to start a sole proprietorship. Now, hopefully you have watched some of the videos to learn a little bit about the context and extra information and aren't just plugging in the sample problems, because there's a lot of additional information in those videos, those short 10-minute videos that are posted. And you're going to want to watch those MyLab videos to get the full learning associated with these chapters. The sample problems are just part of the equation. All right, now what is a disadvantage of opening a sole proprietorship? Well, if I own a sole proprietorship and I walk out in the street and get hit by a bus, my business disappears because there's no legal separation between me and my business. Therefore, if I go away, the business goes away. So there's no continuous life or transferability of ownership with a sole proprietorship. I can sell all the stuff, but because there isn't a legal entity, I can't transfer that entity to somebody else, okay? Now, another disadvantage is if something goes wrong in my business and somebody sues me, I have no legal protection as a sole proprietor because there's no legal separation between me and my business. So if I do something wrong and somebody sues me for it, I could lose everything that I personally own. So having no legal protection and unlimited liability of the owner is definitely a disadvantage of a sole proprietorship. Another disadvantage of having a sole proprietorship is that I could make a bunch of money my first year, but decide that I want to reinvest that money into my company. So I'm not actually getting that cash out, but I will still have to pay taxes on that money, even if I don't pull it out of the company. So if the company makes money, I have to pay taxes on the money that it makes, regardless of whether I take that money out myself. So having the owner pay tax on the proprietorship's earnings is a disadvantage of a sole proprietorship. All right, I'm going to wrap up this video and start a new video for the remaining questions on chapter 1.